Thank you very much, Gilbert and the GCFF, for the opportunity to come back today and share some ideas with you and with all of the attendees. Thank you also to the attendees for your time and attention to this really, really important and exciting topic. I actually think that the lithium-ion supply chain, all of the aspects of it, from the mining and the refining to battery manufacturing, is going to be a really exciting place to be an investor out over the next 10 years. You know, this is not necessarily a cyclical move as we've seen with a lot of the metals. This is really a structural change in terms of how we think about mobility and automation, and of course how we think about energy generation as well. And it really all comes back to the lithium-ion battery. And so what I'd like to do today is, again, really just share some ideas around looking at supply chains today. How has China maintained such a huge lead in terms of the build out and owning various supply chains? And is there anything that we in the West, whether or not it's here in the United States or in Canada or in the European Union, can do to compete? So I won't spend too much time on my bio. I'll make this presentation available for anybody who would like it afterwards, but just a little bit about myself. I have been active in financial markets for about the last 20 years. I've been in New York, and I have recently relocated to Washington, D.C. About 10 years ago, as Gilbert mentioned, put together my own advisory business focused on this idea of energy metals or battery metal supply chains. And so I'll work with all sorts of different client types, whether or not they're hedge funds or other mining companies, all really looking to understand the opportunities and the threats that are basically facing us in the battery metal supply chain. Now, just in terms of an agenda, what I'd really like to do is take the next, 15 to 20 minutes of your time and leave a little bit of time at the end for Q&A, but talk about or really try and address 4 specific questions. Number one, how did we get here? What is the current state of play? And then secondly, what are the catalysts for the critical metal supply chain rebuild? In other words, what are the major forces pushing this supply chain rebuild forward? Number 3, what is the competitive landscape and raw material requirements? So in other words, what's happening in China, what's happening in the United States, what's happening all over the world from a policy perspective to build out these supply chains? And then finally, what is the global impact? In other words, what could the market look like in 5 to 10 years? And most importantly, I would argue, to those of us who invest in the raw materials, what are those impacts going to look like? Okay, so to get started, how did we get here? Okay, there are any number of ways, I think, to think about this, but there are really 2 primary factors or 2 primary events that have taken place in the last couple of years that really put this idea of rebuilding critical metals supply chains in front of all of us. Number 1 is, of course, the US-China trade war, begun under President Trump and countered by President Xi. I personally do not see any change in tact or tactics with the Biden administration. If anything, the Biden administration has been so focused on green growth and domestic supply chain build out that I would argue that the US-China trade friction is going to stay in place. And of course, this has implications for raw material demand that we'll talk to. So that's the first issue, the US-China trade war, which is going to continue. The second issue is, of course, COVID, which still continues to this day to make itself felt. And so I think the question that you want to ask yourself is, so what has been the response, whether or not it's from various industries or various governments, to these twin shocks to the global economy? And if we take a look at the first shock in a second, you want to think first about who are the main players, who are the main factors, what are the main factors in this drama, this trade drama. And I think it's pretty self-explanatory. There's an enormous political component to the tension between the United States and China, but there's also a very important financial and economic component. And so, of course, President Xi, President Biden really dictating and I think setting policy going forward And of course, on the financial and the economic side, you have Secretary of the Treasury Janet Yellen here in the United States, and the head of the PBOC in China, Mr. Yi Gang, all sort of facing off against each other over the coming years as these supply chains get worked out and get built. Now, speaking about what some of the catalysts are for this rebuild, any central bank throughout the world, whether or not it's in China, the United States, Canada, the response to COVID and the real, I think, method to try and generate economic growth and lower unemployment has been to increase the money supply, the local money supply. And so what you're looking at here is one data point that, quite frankly, you could find similar data anywhere in the world. You're looking at what's known as the M2 money supply here in the United States. M2 quite simply refers to one of the ways to measure the amount of currency or the amount of liquidity in the economy. And you can see how, as COVID really hit the United States and the global economy in particular, the Federal Reserve has decided to flood the economy, flood the global economy with US dollars. And that's what this looks like. And this, of course, has implications for interest rates and for currency values that we'll talk about here going forward. And so, look, if you have a situation where there's a tremendous amount of liquidity in the system, my view is that that is going to keep interest rates quite low going forward. A lot of that has to do with economic activity, which remains to be seen. But what you're looking at here, I would argue, is a very important chart that can tell you what the cost of capital for a project is going to be. All right. And so what we're looking at here is the US 10-year Treasury yield going back to the 1960s, the early 1960s. And you can see how over time, you know, this has been a real bull market in bonds because interest rates have continued to fall. And one of the things that I find interesting about this chart is that for all of the concern these days about flooding the economy with money and the potential effects of inflation on the economy, interest rates are still very, very low by any historical standard. Okay, there are a number of different ways to look at this, but the real takeaway from this screen and why it's important for battery metals is that this is indicative of what the cost of capital is for various projects. Okay, it's still very, very low. So a low cost of capital and available financing means that your payback period for your projects is typically shorter. And of course, your internal rate of return is going to be higher. So for all of the concern, I would argue, about interest rates spiking and economic activity really running into trouble, I just don't think that interest rates where they are today indicates that that is an imminent problem. And when you look at the types of statements that central bankers are making, it seems like interest rates are going to be much lower for much longer, which again is very positive, I would argue, for supply chain build out. Of course, as interest rates have continued to fall and as other fiscal and monetary effects have taken hold, you can see that the US dollar in particular throughout 2020 became quite a bit weaker. And the other side of that coin is, of course, the Chinese currency, the yuan, has become quite a bit stronger. So this has implications, I would argue, for imports and exports and trade balances overall. Obviously, a weaker currency helps your local exporters, which, you know, is a real challenge, I would argue, for China going forward, because much of the domestic economy, at least in China, is built on an export machine. And of course, an increasingly strengthening currency throws that into doubt somewhat. And so moving now very briefly to how all of this liquidity and low interest rates and this need to build out supply chains affects financial markets. Okay, we could put just a full hour conversation together on this individual topic, but it is worth addressing. There are a number of different ways to view how all of this liquidity is affecting financial asset values. And so what I have chosen here today to show you is a historical chart of two very popular exchange traded funds. Okay, the orange line that you see there is the energy, one of the largest, or I think maybe the largest energy ETF. That's the ticker there is XLE here in the United States. And the white line is the battery metals ETF, one of the most popular battery metals ETFs, and that ticker is LIT. And so you can see how, they generally speaking have tracked each other, of course, in early or in late March of 2020, when COVID really started to hit the global economy. Both fell in value rather dramatically. And then you've seen this interesting divergence that I point to right here, sort of late last year, mid last year to late last year. The value of these two ETFs has generally diverged. And there's a really interesting debate that is raging right now between battery metals bulls and oil and gas bulls. And the question is, when you look at this chart, are you looking at a liquidity fueled bubble? In other words, is all of that liquidity really unnecessarily and pushing up battery metals prices? Or is it a situation where this is evidence of a structural shift away from hydrocarbons and towards electrification and that whole electrification theme? I think, to be honest, there is truth in both arguments. When you look at some values of some of various financial assets or various equities, yes, they are out of whack by any fundamental basis, but nevertheless, I do think what this chart recommends and suggests is that we're at the beginning stages of this very interesting secular shift, at least in terms of energy generation and energy storage, and of course, mobility. And that's what this chart, I think, really represents. I think the second wave, or the second catalyst in favor of battery metals, has to do with technology, okay? And this is something that is not new, and I have talked about many, many times before, but it's this idea of cost deflation. So technology cost deflation really tells a powerful story. And again, we don't have time to get into a lot of the details here, but you can see on the left-hand side of this screen the rollout of solar photovoltaic electricity generating capacity relative to coal. This is according to the International Energy Agency. And of course, we all know that the challenges with renewables have to do with the intermittency, okay, whether or not it's solar or wind, and they really will not be effective without battery backup. And that's what the right-hand side of the right-hand chart of this screen represents. It's the cost decrease, according to Bloomberg, in the battery pack price of a lithium-ion battery pack, okay? And you can see how it's continued to fall up to the point where we now know in 2020, last year, prices fell by another 10% to about $137 per kilowatt hour. At this rate, you're looking at a situation where by 2024, an unsubsidized electric vehicle will be at cost parity with an internal combustion engine car. So we're very, very close to that tipping point that we've heard so much about. And then, of course, there's this inverse relationship between battery pricing and EV sales. So as battery prices continue to fall, EV sales continue to take off. Even with COVID kind of grinding the global economy to a halt for the first half of last year, EV sales grew last year by to the point where, as you can see here, EV sales, meaning all electric vehicles, batteries, plug-ins, so on and so forth, were about 4% of new sales globally. My modeling suggests that that number will be at around at least 10% by 2025. And so the trajectory of this chart is going to continue. And again, it is inversely related to the battery pricing. So battery pricing falling, EV sales, of course, coupled with subsidies, very generous government backups, really pushing EV pricing higher. EV sales, I should say, excuse me. And so you have this interesting, again, a monetary and a fiscal response, you have a technological response, and you also have this very, I think, longer term powerful policy response. And this speaks to the competitive dynamics, in particular, between the United States and China. And so what is happening in the United States around supply chain development for critical minerals? To be honest, there are numerous pieces of legislation. I just chose a few that are very well known here to indicate the types of things that are happening along the critical metals supply chain. The most important thing to remember, and my fundamental thesis around investing in the supply chain here is that you really will not be able to successfully build out the supply chain without secure access to the raw materials, the lithium, the cobalt, even the copper and the nickel, the bigger, I like to call them the big brothers of the battery metals space. And we'll take a look at them here in a few minutes. But anyway, as you can see here, the United States, according to the US Geological Service, even today, after all of the awareness about this issue, is still 100% dependent on imports, I should say, of 18 minerals and metals, and 75% dependent on imports of 32. So, we in the West, whether or not we're here in the United States or in the Eurozone, we will not be able to successfully compete with China unless we address this issue of critical metal dependency. And that's what a lot of this legislation that you see here is designed to try and counteract. And of course, China has really roared ahead. Okay, China continues to push what I would call its state-centered industrial policy. Of course, whether or not that's rare earths or lithium or cobalt or what have you, any number of examples I think we can look at. The Ministry of Industry and Information Technology, of course, has released draft rules around standardizing its domestic rare earth industry, moving upstream, making sure that the dominance of the supply chain that China has is kept in place. And it looks like that's going to happen for some time to come. Of course, other more well-known, I think, policy issues, the 14th five-year plan, we're still learning quite a bit about that. This idea of dual circulation, which is designed actually to increase domestic consumption. I call it rhetoric because we really don't know much about how it's supposed to roll out. But there are other aspects, of course, the Belt and Road Initiative, and whether or not countries that China approaches are willing to take on debt in exchange for infrastructure build out and, of course, resources. And Made in China 2025, which really works hand in hand with this dual circulation strategy of stimulating domestic consumption and rebuilding internal supply chains. So neither the US nor China, nor the Eurozone for that matter, are really sitting still. I think we all realize what the size of the prize is here, and the legislation that I'm introducing, or at least discussing today, is designed to solidify these supply chains. So just finishing up, what does this mean for the metals? Okay, and perhaps we can talk about this during the Q&A. As I indicated earlier, nickel and copper, I like to call them the big brothers of the battery metals sector because they are very large and deep liquid markets. And they have really benefited in 2020 and into 2021 from a weaker US dollar and China effectively restocking. Gilbert had some great commentary in his opening about nickel and copper, and I would completely agree with it. China is, of course, responsible for anywhere from 40 to 50% of nickel and copper consumption globally. So as China emerges from COVID, it's no surprise to see nickel and copper pricing perform very, very well over the last year or so. Of course, turning to some of the minor metals, this rather odd-looking chart is the price of battery-grade lithium carbonate inside China. And you can see right now we are actually emerging rather strongly from a pretty tough, uncomfortable 2-year hangover where prices have been falling. For those of you who are bullish on battery metals on the Zoom call today, I would encourage you to realize that typically what happens in China with respect to pricing will happen in the rest of the world 6 to 9 months later. So as we see this bend, this upward push in pricing late last year and into 2021, I would argue that that is going to happen for lithium, battery-grade lithium pricing, whether or not it's lithium carbonate or lithium hydroxide, probably much later in 2021 for the rest of the world. So again, that has investment implications specifically. And then, of course, one last example. I don't think you can have a discussion about critical metal supply chains without addressing, or at least talking about, rare earths and rare earth elements. As I mentioned earlier, China controls roughly 80% of the global rare earth supply chain, from mining and refining to magnet manufacturing. This is a chart of the price performance in the Chinese currency of neodymium. Neodymium is one of the critical rare earth elements utilized in the magnets, I should say. Sorry, I just lost my train of thought there. Utilized in magnets for electric vehicle motors. And if you take a look at where I think EV sales are going, as I mentioned before, 10% of sales globally, it's no surprise to see neodymium pricing having taken off. Again, we could spend just an hour talking about rare earths and the geopolitical dynamics that underlie these metals, these critical metals, but nevertheless, I think a weaker dollar and of course just demand around a lot of the minor metals and the rare earth metals is what's really pushing prices up pretty consistently across the board, as we can see here today. So maybe just to summarize, and then I'm happy to take any questions, you know, 2021 and beyond. So what happens this year? And, you know, I'm willing to say that my forecasts are, you know, about as good as anybody else's out there. I just sort of look at the data and try and piece it together. My view is that the US dollar is going to continue to weaken throughout this year. Again, you can't have so much fiscal and monetary stimulus in the economy and not have the dollar under pressure. The good news, I would argue, for commodity investors is that is going to push commodity prices, in particular commodities that are denominated in US dollars, higher. And that's one of the things that we've already seen throughout 2020 with copper and nickel. I get a lot of questions about incentive pricing with respect to lithium in particular. My own view is that as lithium demand grows at 20% a year compounded for the next 5 years, you're going to have to see the incentive price for lithium go much higher, okay? And it could be as high as 30% from where we are today. Again, owing to the fiscal and monetary stimulus that I mentioned earlier, I think that interest rates and the cost of capital, in other words, the cost to borrow to finance projects, is going to remain quite low going forward. And that's very, very positive for supply chain rebuild. Again, separate conversation, arguably, but this US-China trade friction is not going to change at all, really, under a President Biden administration. Maybe there will be less rhetoric and it won't be quite as inflammatory as it was under President Trump, but this is really going to stay in place. And I think it's going to encourage more localized supply chain rebuilds, which again underlies the main point of the investment thesis here, which is without raw material security of supply, you will not be able to successfully build out a localized or even a regional cross-border supply chain. So again, we've talked about EV sales. I think they continue to accelerate. You know, the lithium market will triple in size between now and 2025. And just copper and nickel in the battery business and the EV business alone could go anywhere from 2 to 4 times their current usage just by mid-decade. And then I think actually later in the decade, things get really, really interesting because we will have passed that tipping point for cost parity that I mentioned before. So again, I just want to say thank you all very much for your time and your attention. Hopefully I was able to give you some food for thought and set the table today for what I think is going to be a great day of presentations. Also, thank you to the GCFF and Gilbert in particular for the opportunity to come and speak with you. And you can see, here's how you can contact me, and I'm happy to take any questions in the time we have left.
Thank you. You're welcome for your comments, Chris. Very good insights there. We have a couple minutes, so we'll take a few questions here. Let me go to the Chinese side here. The first question coming from Kenzie. He's asking, let me translate that a bit in English. So I think he's asking, do you think EV will one day completely displace, let's say, the traditional cars, the combustion engine cars? Do you think hybrid will be the way? What's your thoughts on that?
That's a great question, and that's a question that I think the industry is really struggling with right now. I think for EVs to become 100% of the global automotive fleet, that's going to take decades, okay? and it's going to take decades because you have to really break down the automotive business, and you have to say there's the light duty segment. So that's Tesla, that's Volkswagen, that's BYD. And then of course there's buses, there's trucks. There are a number of different ways to look at the automotive business. I would think that you would see fleets, so large trucks or buses, convert to 100% electric first before you saw 100% electric penetration on the light duty side. Keep in mind that, you know, the typical internal combustion engine car will last you anywhere from, I don't know, 10 to 12 years now. So even if we go to 2025, and as I mentioned before, I think that we can have a 10% global EV penetration rate by 2025. That still means that 90% of sales in that year are not electric. So yes, maybe some of them could be hybrids, but you know, the majority of sales arguably will still be internal combustion engines. So that's sort of how I think things play out between now and 2025. But from 2025 to 2030, I think you see EV sales really accelerate. And again, it has everything to do with the overall cost of the battery, which really drives the cost of the car.
Okay, thank you, Chris. We got a couple more questions, but I think we're a bit over time now. So I will actually try to forward this question to you after this. We'll have to let you go now, but it's very good to have you here for us to start off the conference today.
Wonderful. Thank you again very much, Gilbert, and thank you all for your time and attention.
Thank you, Chris. We'll talk soon.
Okay.